Well, hello everyone. Don Garman here again from Mirador Capital Partners. And here we are coming to the end of October, of course, in the pandemic year 2020. And I wanted to come check in with you, share a few updated thoughts. This happens to be the week of the Schwab Annual Impact Conference, which is something that we generally all, or many of us, attend in person. Of course, this year's all virtual, and you get to hear from people leading their fields in a variety of different subjects, from Sal Khan of Khan Academy to Condoleezza Rice spoke today, and Sugar Ray Leonard about how to stay motivated, and a whole bunch of interesting topics. And so we've been tuned into that. Of course, I wanted to check in because the markets have been unsettled for all the reasons that I think we can all understand. It is easier to come to you today because the last time we checked in, which was 2 weeks ago, I said, somewhat sheepishly, that we were going to be strapping things down ahead of what we expected to be some heightened volatility. And I could tell from the universal positive response to that I got from our clients that was everyone thought that was a great idea. And of course, with no perfect foresight, I'm glad we did. Anytime you run into a market that looks like this one does, you of course wish you had done more, and so that is always true. However, what I'm going to give you today is just a couple reasons, and happens to be the charts of the last year of the blue line being the S&P 500, weighted heavily by the 4 or 5 or 6 actually tech stocks that have kind of been declared the winners of the pandemic, and then on down to emerging markets, the Russell 2000, which is the US small cap index, and the EFA, which is the European, Europe, Far East, and Asia is what it stands for. So it's sort of large companies outside the US. So as you can see from the right side of this chart, something happened about a week ago and everything started to look like a ski slope. And so that to me seems pretty easy to explain because we have had a lot of interest in moving to the sidelines around the election. And I am of the opinion, which I don't think is particularly novel at this point, that next Tuesday isn't probably going to be the conclusion of the election by historical standards, and that there could be any number of challenges coming from a variety of directions about the results of the election. So I think it's safe to expect that this is going to be a rocky period, and no one ever complains about, rocky up period. So what I really mean is it's probably going to be a rocky down period for some period of time. But even if we knew that with 100% certainty, then the question becomes what to do, right? So even if we decided we were going to sell everything, then we would have to be left with the decision of what to do then. And so that would mean if we knew how to execute that perfectly, we would wait for lower prices and then we would buy something back. We know certain things are still true. Interest rates are still zero, which is definitely less than the cost of living, which is positive, right? All of my bills, even through the pandemic, have stayed the same. Electricity, food, those type of things. Obviously, my travel budget is not what it was last year, but other costs are still rising. So with zero interest rates, cash is unattractive relative to inflation. Bonds is unattractive relative to inflation. So then we're back to, okay, somehow companies will be the answer to what to do with money. And then we're back to what companies. And that's the position that we are always in. And I look at our holdings today, as I did yesterday when prices were a little higher, and last week when they were higher still. And I would say if the prices were lower in a month and we had all cash, I would buy the exact same stuff we own now, all back. So what is how do we, how are we dealing with that fact? We deal with it by hedging and increasing the amount of exposure we have to simply the stock market going down, something goes up, and that is what we did 2 weeks ago. So we get through these periods mathematically in a lot better shape than others who don't have that style. And if you look back, and now I think enough of you have gone through the mathematical exercise of what happened in March during the heart of the pandemic and how much more we contained the damage, and how the math of containing the damage makes us have to do less on the upside to get back to highs, exactly what happened post-March and into the summer. And so here we are again executing the same playbook. If you trace it all through, if you can measure the math of where you are relative to even those market indexes, those unmanaged indexes I just put up, we have far more money than we would doing it another way. So it isn't comfortable 100% of the time. There are people who do better doing it differently over certain periods of time. The style we choose is a style that will always work, which means some segment of it will always not work. Their diversification means that there will always be owning some things that don't work. That's what it means. That's why it works. So anyhow, that's a long explanation to the core of the philosophy that we continue to repeat over and over again about why we do it the way we do it. Preserving outs, owning a lot of different things that aren't, moving in the same direction, they're moving in opposite directions. And so I would say I'm not going to get too freaked out today, because before the 2016 election, the market went down the 9 straight days before the election. And then election night, futures were off like 7%. So it was, and we all remember, if you don't, I pardon me for refreshing your memory, but that night it was a cataclysmic reaction among a certain group of people and euphoric reaction among another group of people, and everything was kind of going haywire. And so we kind of stuck to our knitting then, and everything worked out great. And so I can't promise that this is going to be a completely comfortable next few months. I expect it will be uncomfortable. However, the philosophy will continue to work. It will persist. It will get us through this and the next crisis after it. And I think that we can only know that they will be coming, because that's the way the world is. So anyway, I didn't want to not touch base. It has been 2 weeks, and people seem to enjoy when we touch base. So here we are. Reach out with questions or concerns. Specific people have reached out with direct orders about their positioning. That's always your prerogative. But one thing you can always rest assured with us is we are in exactly the same boat as you are with your family. So we're going to continue to execute the style for our families, and encourage you to do the same. But everybody has to make some decisions about these things in terms of their sleep for themselves. And so we are here to have those discussions and to be honest and to try to think long-term and strategic about what's best and who will ultimately win. And so those are the type of discussions we're always prepared to have. So until next week or the next 2 weeks, everybody will be monitoring the same information. And all we can do is hope for the best for America and for each other and for our families, and whatever everybody decides to do for Thanksgiving, we'll certainly be chatting with you before then. So anyway, thanks.